said, Brexit is the big event now, and I think all central banks are worried about Brexit. So if this could serve as one of the excuses for the Fed not to raise rates. This is, I think, why the Swiss National Bank is waiting and being sort of careful ahead of the Brexit, because if the pound falls, the euro falls, and then the Swiss franc, safe haven flows come into the Swiss franc. So, and of course the Bank of England is ready for liquidity, the European Central Bank. The Bank of Japan does not like the strengthening of the yen due to safe haven. So everything now is around Brexit or no Brexit. It's 8 days to go until we get the first results. So it's all about that. In general, there still is, I mean, if we look central bank by central bank, we still have some kind of small divergence. The Fed is still on the path to raise rates. It's not going to reverse rates. Okay, so maybe we'll have only one rate hike in 2016 in December, but at least for now they're still talking about raising rates. Other central banks are more or less moving in the other direction, so that's the basic thing. We might have more stimulus from the Bank of Japan if we go by central bank according to their importance. Japan and the Bank of Japan could introduce helicopter money. I mean, that's a real option. The Japanese Prime Minister is very worried about the global economy. The pound, I don't think they will raise rates in case of a Brexit. It's a developed economy. It's not a third world one. They'll leave the situation as is, wait for the dust to settle, and perhaps even cut rates to support the economy in case of a Brexit. The European Central Bank is a bit out of munition, but they could QE anyway. They're not years. So the Bank of Canada is a bit more optimistic, but they have lowered their lower bound for rates to minus 0.5. Currently it's at plus 0.5. Of course, if the US economy enters a recession, Canada will follow and then they'll cut rates, but I don't think that's so likely. And Australia and New Zealand situation there isn't that bad, but we'll hear today from the Fed also about China, also an excuse not to raise rates. So these two economies could also suffer from China, so they have more scope to cut rates and perhaps counteract that with some macroprudential tools to, cool down the real estate sector. So all in all, the situation isn't that good, and the US dollar is still cleanest shirt in the dirty pile. The US Federal Reserve is still the only central bank that might raise rates sometime soon. The other ones are going in the other direction. Maybe if Valeria has something to add.
No, I totally agree with you. There is a clear imbalance between the Fed and the rest of the world central banks, right? Pretty much none is in the path of rising rates, and the Fed had already provided one, and it's expected to provide at least two this year, right? And we're talking of a possibility of Japan adding stimulus, the ECB extending it ad eternum, and even we are talking about a rate cut in Australia these days, although I does believe that that one is the less likely at this point, right? But anyway, the imbalance is there, but it has been for so long already, right? It has been like 2 or 3 years we have been talking about this imbalance, and I got the feeling like the market is not paying much attention these days to the imbalance between central banks, because one thing is what the Fed says and the other is what the Fed does. So unless we actually have a rate hike in the US, the imbalance will take the background, you know what I mean? And won't be relevant. It will become relevant, of course, if and when the Fed raises rates.